Hey guys, how you doing? Twice in one day, right? Had to do it one more time before I get out of here. Let's make sure we're good. Yeah, I don't know. I guess it's the new year, and I'm not frustrated about what I'm about to say because I get it. I understand. People, at this time of the year are seeing things online, and when it comes to owing money and things of that nature, folks are trying to figure out ways to pay that debt off as soon as possible. I get it. I've tried to go through and make my case on what I'm going to be talking about here as benignly as possible to wash away the people that have been sending me this video that I'm about to show you. But per the thumbnail, uh, I'm from the mindset that this HELOC thing, and it's not new. It's been around for a while. Uh, been around for a while. I mean, many years in the aughts. I remember it back in 2010. Uh, is it something that possibly could be done? Yeah, but in very few cases. So what I'm going to do is I'm not going to talk down on the situation, but try to give you some information uh, to help you understand the pros and the cons of using the equity in your home. Uh, Number one. Number two, if you want to pay off your home, a much better strategy for you to do so. And so that is the purpose of the video. If you guys have any questions, comments, or concerns while I'm doing so, don't hesitate to type them in and we'll try to get to it. So without further ado, this is what was sent to me. I had to find the guy. His name is Myron Golden. Okay, gentleman here, and this is what's been sent to me a couple of times today. Let's listen. Hopefully, you guys can hear this. What would be better for a person to do than that? Let's say you understand the money game. What would be better would be to get a home equity line of credit for the equity that you have and put that home equity line of credit in the first position if you can. Make your mortgage a home equity line of credit. And then every time you get paid, deposit your check into your mortgage balance and then use the checkbook that comes with your home equity line of credit to pay your bills. You'll pay off your mortgage probably in 3 to 7 years if you do that. Like making the exact same amount of money you make right now, you'll pay off your mortgage in 3 to 7 years, 12 at the outside, instead of paying off your mortgage in 30 years. So sounds good, right? Sounds good. And again, I guess we're at this time of the year. So the first thing that you need to notice, and I put it here on the screen, right here. Okay, three types of loans when you're thinking about equity in your home. So he's mentioning a HELOC, home equity line of credit. Uh, it's a credit card. It's a open-ended revolving line of credit, meaning the concept is you can get the home equity line of credit, have it at zero, and at some point in time you go pull monies off, okay, and pay those monies back, and that account is not closed. It's a credit card. It's a home equity line of credit. Something new that folks have been talking about or coining. It's a second mortgage to me, but they call them HELOCs. Okay, it's just a second mortgage where you have a second behind your first, tapping into that equity. Okay, but it's a fixed interest rate and cost a little more as far as costs are concerned. Interest rates are going to be higher than the initial teaser rates a lot of times on the home equity line of credit. And then if you're in Texas, my home state, I want to show you or talk to you about that because HELOCs in Texas really can't do them. There might be a few banks, actually depository banks, that might, give one to you, or credit unions, more along the lines there. But in very few cases, because of the A6 laws that we have here, the homestead laws, right? But in Texas, you can do cash out, but you cannot exceed 80% of the appraised value of the home. Okay. So that's why a lot of folks don't do the HELOCs here in Texas. Those are the three flavors. Back to what the gentleman was saying. The first problem that you're going to have, you know what? Before I do that, I'm going too quick. They say I go too quick. Let me cook a little bit. The first thing I want you guys to do is ask this question: who is this guy? I don't know. I never heard of him. But he's got a YouTube channel, got a lot of followers. Okay. So off the top, again, we're in a capitalistic society. You can make money, but I know and understand attention is the currency. And folks will say whatever to get your attention. Okay. And I say that to say this, everything that I looked at from the gentleman, right? Uh, he's using the Bible to sell stuff. I don't agree with that. That's just me personally. Um, he got all kinds of, he looks like a marketer. Didn't find anywhere where he was a loan officer or that he does loans. So that's the first thing that I want you guys to please start trying to do. Vet the sources of this information. The internet is beautiful. It's a beautiful thing. But you have to beware because anybody could pick up a camera now and the barrier to entry is low and they can say all kinds of things. And unfortunately, a lot of folks want to be out of debt quickly. Okay. So the best way to get out of debt quickly is don't get into debt. I get it. We're talking about homes, but you have to understand the concept. It's amortized over 30 years, most folks, because you don't have those big lump sums of money. So the first issue, I digress, what he was saying is, and if you don't understand this with a HELOC, all loan types, they have a maximum loan to value. Okay. Maximum loan to value. So in his example, he said that you would replace your first loan, your first lien with the HELOC. Well, you either have to have a home that has, excuse me, a ton of equity to make the loan to values work, or one that's almost paid in full. How many of you does that apply to? Not many, right? That's why this is appealing to you because somebody's saying, hey, you can pay this off in 5 to 7 years. The second thing that you have to realize is the concept of leverage is a great thing when it's levered the right way. All of these credit score lust that we have and tricks to get into debt, we're tricking ourselves. Okay. The borrower is serving to the lender. So you only want to leverage when it makes sense. You only want to lever when it makes sense. Things like real estate and things of that nature. Okay. Respectfully. So we got to get out of this love that we have with being in debt because at the end of the day, it's still debt. We want to get into the good debt, right? So that's why this thing is popping off, I believe, because folks want to get out of that. I like that. I like that. That's a good thing. And before we get out of here, I'm going to show you how you can pay off your loan in however many years you want to and not have to go through these machinations and get yourself caught up. Because these products, these financial products were created for people at the lower end of the spectrum or folks they don't have any other remedy when they've lost a job or something of that nature. Equity in the home. The bank, right? It makes sense. Not mad at you, but you got to understand that, right? Let's move forward. So the first thing I want you to understand, my first bullet point up there is a HELOC. It's a credit card. It's a revolving line of credit. Let's say you were able to pay off the balance on your first loan, whatever it was, or you had enough equity to make that work. Well, as soon as you put that large amount, anybody that's been following me, what's the number one issue when it comes to revolving debt? See if anybody's going to say anything. It's utilization, assuming that you're making your payments and things of that nature, right? But the utilization of the card. So what do you think happens if in a situation like this, if you utilize the card to its full, what is it going to do to your credit scores? It's going to tank them. I learned this from, not learned it, but I used to watch the Quack Brothers. Quack Brothers. You guys can look them up on YouTube. And they used to sell this heavy, right? And again, it sells, man. I'm not mad at them. It sells. That's all it is. You got to crunch the numbers. You got to know you. But so it's a revolving line of credit. Now, One thing that a lot of folks don't realize is this concept has been around over 100 years. And it wasn't until, here's the education, 1986, Ronald Reagan, 1986, okay, there was some tax reforms, and 1993 to tag onto it when Clinton got in office. But bottom line, prior to 86, you could write off the interest on a lot of other lending that you were doing. They made that reformation and basically got rid of the rest of that stuff and just associated it to your mortgage. Okay? And so again, when you understand the concept of it, right? You have people making you believe that a mortgage over 30 years is a horrible thing, but you have to know and understand we're the only ones on the planet that have the opportunity to lever like that. And that's very important for people coming from the bottom. That's why you always hear me lamenting about you guys buying and not getting caught hoodwinked, especially young folks, into thinking that you want to rent because you really don't. You just don't know what you don't know yet, respectfully. But leverage is a good thing and amortization is a good thing, especially when you're coming from the bottom and you have to get on the ladder until the time you can reposition and then start attacking the principal. But 1986 is when all this was put in the mix, really. Okay. It really went crazy. 93, Clinton came in and did some other changes. But now the interest that is associated with loans, more than not, is only written off when it's dealing with a mortgage. It's very important for you to know that, right? And so the powers that be going up into the turn of the century and then the 2000s and things right before the great debacle, there was a ton of home equity in going on. Okay, I had a lot of clients coming from California, coming to Texas, pulling out equity out of their homes to buy homes here, thinking that homes here were going to appreciate like they do out there. And I was telling them, no, 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 that's not going to happen here. We steady Eddie, 2, maybe 5% on a good year, depending on whatever MSA you're in. Couldn't tell them anything either, right? I digress again. The point I'm trying to make is it was prevalent at that time. Folks pulling out equity. And to be honest with you, if you're going to lever up your equity, I would suggest that you do so in a manner that they were, like as an investor or something of that nature. Just folks didn't understand what was going on because there was a ton of easy lending going on and a lot of surplus. And a bubble was a brewing because when it burst, you had all of these folks with all of these crazy loan products, adjustable rate mortgages and things of that nature that they couldn't pay because they would lever up. And they were at Vegas. They were in Vegas. They were gambling. And that's something that I don't want you guys to do. This very strategy speaks to the gambler in you. Okay, we got to stop gambling. We got to look at this stuff logically and understand it takes time, man. We all can't make moves at the same time. It takes time. Nobody wants to tell you that. I do. That's just the facts. You'll have a few people that accelerate in your cohort, your age group, but more than not, it takes time. It takes time. Okay? But anyway, back to the history. So these HELOCs have been around and they were designed for a certain reason. Last bastion, right? This is the last thing that I have to try to save what we have. Well, according to I put up an article because I want to talk all the time. Let's see here. According to who is this? Bankrate. Okay. Bankrate, and this is from September 13th, 2023. Here's the deal. Oh, I got it highlighted. Key takeaways. Let's look at the key takeaways. Using a HELOC to pay off your mortgage can be a strategic move, especially if you have a lot of equity in your home and a small outstanding balance. That goes to my first point. Most of you guys don't have enough to pay off the first or a lot of equity in the home. So that is dead, right? But the point I want to make is here's the point. As of Q2, second quarter of this past year, 2023, the average mortgage holder had almost 200 grand in equity. That's another reason you're seeing this stuff pop off, right? Because folks, uh, this brother here, he looks slick with it. I could just tell. I don't even know who he is. I know he making money. He got his game tight, right? And anytime they start prepping the scriptures, they really making money. You feel what I'm saying? I can only imagine how much money he's making. So consider the source, man. Consider the source. And is he a loan officer? No, not from where I can find. If you guys could correct me, you guys could correct me. Okay. I'll stand, I'll repent without a problem. So, anywho, revolving debt, it's adjustable rate mortgage. And where I was going with the history of these things back in the 2000s, Citibank, uh, Wells Fargo, a lot of these folks shut down these credit limits. I'll tell you a personal story, right? We had a house in Chicago that needed to be renovated. I went to Chase, got a business line of credit, same concept, never missed a payment, um, was utilizing the credit line like I was supposed to. They just sent me a letter one day and said, we shutting it down. That's another danger of a HELOC, right? That's why you shouldn't use it to, buy RVs and go on vacations, and you can do what you want to. But again, it's debt that's tied to your home that a lot of you guys say you want to pass down to your next generation. I'm starting to think some of y'all cap on that. Y'all ain't no generational wealth. Y'all talking about me. For real, for real. But anywho, I may be wrong. But you want to protect that with all you can. You feel what I'm saying? And if you're going to tap into it, you want to lever, you want to utilize it in a place where it can grow, right? Short-term investments, because it's very volatile and it's tied directly to the Fed funds rate. You know that run up in interest rates that happen, and folks think that it's directly correlated to mortgages. It's not, but it's directly correlated to credit cards. That's what a HELOC is a revolving line of credit. Okay. So it's very volatile. And there's set terms. That's what a lot of people don't realize. The more generous ones, you have 10 years. I had a couple of people last year that long time clients of mine got caught out, because we went through a couple of years of real low rates. And see, my point is this, not to get off too much. We are creatures of habit. You're going to mess around and get that debt, and you're going to have that debt too. That's why I don't really like doing consolidations to pay off credit cards, right? Because in most cases, you're going to go right back into the debt. The good thing is, hopefully you have a house where you can tap into your bank, because I got clients like that. But I always 100% take you to the next 5-year interval, lower your term, okay? If not 15 years or less, every time I refinance somebody. That's the only reason I'll do it, especially if I see you're a habitual debt user, okay? Because those credit cards are going to blow back up again. You see what I'm saying? So we have to understand these things. I'm getting to it. Let me move forward. So let's see, adjustable rate mortgage. It's a revolving line of credit. If it starts getting tight, they will shut it down. You have certain draw periods, okay? You have minimum draw amounts. And that's another thing people don't realize. You can't just go in and pay this thing in and off like a credit card, because these folks are making money. And you know what? Let me see here. What's the average rates? Yeah, this is good to look at. Let's look at this real quick. Current HELOC rates, January 2nd, 2024, close enough, right? 10-year, 8.35%, 20-year, 8.16%. Y'all kill me with this stuff, man. Everybody wants to run a play, and the play that you're running is worse than what you have. See, I think the reason this really resonates with a lot of people is because you don't have the extra monies that you need to really attack the principal. So you think you have some intricate strategy where you can OPM, use somebody else's money over here at a higher interest rate that's variable and volatile, and you're going to come up with this elaborate scheme to pay off your mark. Man, if you've been blessed to get the 30 years, a lot of y'all barely got in. Leave it alone. Make some more money. I'm going to show you how to attack the principal here in just a minute. Stay with me. No disrespect. Banks can close without notice. I talked about that, right? And another thing that they talk about is you could pay your bills out of these HELOCs. No, you can't. You can't pay all your bills out of this HELOCs, man. Y'all leave this alone, please. Please. So you're going to be limited with your bills because the concept is you take your paycheck, right? And you put it on the HELOC every time you get paid because it's an average daily balance, like a credit card. Y'all about to shoot yourself in the foot. Leave it alone because you can't pay all your bills. Okay. Now it says paying on the principal will give you the same result. Let's get into some solutions, right? And then I'm going to let you go because I've been doing this all day. Brother getting tired. Let's see here. So now here we go. This is a regular mortgage calculator. You pull it up online. That's the beauty about online, man. Back in the day, boy, you had to know some stuff or you could hide things. Folks would hide stuff and make it seem like they were so smart. It's on the internet. You can find what you want to find. Let's look at this $425,000 example. Just an example. 30-year amortization. The loan is 30 years. Interest rate 6.25%. Okay. 360 months. That's equivalent to 30 years. And the normal payment, when we calculate it, it says it's $2,616.80. And this is what a lot of you guys look at. Oh, you're gonna pay the bank $942,000. Hey man, come out of your pocket with the $425 and you don't have to pay the bank anything. You see what I'm saying? Don't let these folks get you guys gassed up. They gonna make you play yourself. Listen to Uncle Rob, okay? Because I got a strategy for you. So the principal and interest portion of the payment, we're not looking at taxes, insurance, HOAs. That's the cost of you living wherever you live, okay? But the principal and interest is $2,016.80. Here's the deal. Y'all want to save about $100,000 on this mortgage? Let me show you how. Everybody talks about that bi-weekly thing. Again, these folks come up with these strategies and it's always tied to you paying another subscription. You could do your own bi-weekly. All bi-weekly is this. Typically, there's, depending on how you're paid. If you're paid bi-monthly, you get paid 24 times a year. If you get paid or semi-monthly, if you get paid bi-weekly, you get paid 26 times a year. Or in essence, that's just one extra pay period a year. And depending on the year, it might be June, July, you get one extra check there. And then December every year, you get one extra check. That's the 26 pay periods, right? Well, if you take that $2,616.80 and divide it by 2, okay, on this calculator is bi-weekly, and that comes out to $1,308.40, $1,308.40. So if you just nowadays online with your servicer, everybody's got a servicer, you can set it up. You can go in and make your payment, okay? If you want to, you could do that. Where it's bi-weekly, because as long as you pay by the 15th of every month, the full payment, okay, you're not hit with a late penalty. It's not until you're 30 days late. But just to show you if you could fit within those parameters, you could do this bi-weekly thing. But watch this number here, right? This is the total interest. What is that? $517,047.32. So by, in essence, paying one extra payment a year, you're just doing it this way every 2 weeks, right? What does it say here? You'll pay off the mortgage in 24 years, 6 months, okay? So this is 5 years and 6 months earlier, and you'll save over $111,772 in interest because you're paying it off sooner. Now, that ought to shake a lot of you guys up because everybody ought to be able to make one extra mortgage payment to your mortgage every year. You see, we got to stop getting out of these concepts in our mind, right? I hadn't been to the gym and I'm going to go to the gym and lift 500 pounds. No, you're not. You got to build up to it. Okay, you got to build up to it. See, a lot of us, depending on where we are in life, we don't have those extra monies. If you got kids and things, and kids are expensive, man. You feel me? A lot of you guys don't even have control of your budget. You got to get control of your budget to see where this extra money is going. But the point I'm trying to make is, hey, you could cut off 100 grand. You can go to the cooler, the coffee table at work, man. I say 100 grand off my mortgage. We like to show off. You know what I'm saying? Had a customer the other day talking about, Mr. Robert, these folks at work are just bad credit like me, and I said they lying. That's not true. They telling you that because they want to, you want to one up somebody. I don't know why people do that, but that's what they do, right? But anywho, you can save that amount. Now watch this. If we take that 130840 times 2, okay, we go back to the regular principal and interest payment. Here, let me do it. Normal, calculate. If you're a little more disciplined, you can set that money to the side. This is what you could do. You could take that 261680, multiply that times 12. So that's $31,401.60, right? Let's divide that by 52 weeks. That's $600 a week or $1,200 every two. Just like I'm saying, right? No, hold on. That's not 31,000. Hold on. 26. Yes, it is. 2616 times 12. Yeah, that's right. It's 31,000, right? So, but I'm getting beside myself. Not 31, but if you take that 261680, there you go. Thank you. Whoever's helping me mentally online, I'm tripping. But if you take that one extra payment and divide it by 52 weeks, that's only $50.32 a week. Set it to the side. And then at the end of the year, when you make your monthly payment and that extra payment that goes directly to a principal, you just add in an additional $2,616.80. You see, we just got to break the numbers down. Okay. One last thing, because I got to get out of here. So I think he says, hey, you want to pay it off in 7 years, right? So 12 times 7, 84 months. Okay. So if we had $425,000 and interest rate is 6.25%, okay, 84 months. So the principal and interest payment on that is $6,259.70. You would have to, once you got to that point, say you're at that point, right? You'd back out the principal and the interest payment already. You back out this $2,616.80. So you would have to pay an additional $3,642.90 a month. Okay. Let's put that here. Watch this number here. Okay. Watch this number and hit calculate. Boom, right here. It says, so by doing this, you will be paying off your loan in 7 years. You see the 7 years, 23 years earlier. Okay. Resulting in a savings of $416,233. I know 5 people that have done this personally. Okay. They didn't start off, because that's the whole reason you're going to a 30-year for a lot of guys and gals, men and women. You don't have it at that time. But as time goes on, see, what a lot of you guys don't realize is when you know better, you do better. And so instead of all the subscriptions and all of the diversionary tactics, you get focused, okay? And then when that extra money comes, you do what you got to do for a little while if paying off your mortgage is what you want to do, and it could be done. And like I said, I know 5 people that have done this, my clients, right? Be surprised what you could do when you put your mind to it, and you don't have to fall or succumb to all of the sellers. Shout out to the sellers, man. I'm gonna have to watch this brother here because y'all know this dude, Myron Golden. I could just tell. I know when Cass is making money. He probably come from a multi-level. Is he a financial services? These folks with this financial services, you sell insurance, man. You don't have any of the investment license or series. And if you do, I apologize. But quit saying you're a financial advisor. You sell insurance. You might do mortgage loans like myself. You feel what I'm saying? And there's licenses for stuff like that. This dude looks like a multi-level marketing guru, probably making his money by selling courses and things of that nature, right? And I can already see he pimping the Bible, which I don't appreciate. But anywho, there you have it, guys. if if you want to find out what you could do with your equity, again, you're grown. You could do what you want to do. Uh, and you like to, if I didn't tick you off, right? And you need somebody to consult with, hit the link in the comment section. See, even I want something, but at least I'm truthful with it, right? And I'm trying to provide value, and I don't want you to get hoodwinked and bamboozled and get jammed up with all this foolishness. Um, Hit the link, schedule a consultation. Let's have a conversation. If not, keep these things in mind when you're going forward. At the end of the day, it's debt and it must be repaid. Don't dig a deeper hole trying to get out of a hole, right? Sit down, look at your numbers, put a plan of action together. If you're younger or if you're farther away from the goal, relax. It's hard by the yard, but it's a cinch by the inch. Plan, move forward. Some of y'all need to clear your algorithm because cats like this is popping up, and Uncle Golden gonna get your money if you listen to him. I can already tell. Y'all be blessed. Have a good evening. Yeah, yeah. Peace.